So for the last part of our topic, I am going to discuss the objectives, principles, and models of internal control. An organization's internal control system comprises policies, practices, and procedures to achieve four broad objectives. First, to safeguard assets of the firm. Well-designed internal controls protect assets from accidental loss or loss from fraud. Second, to ensure the accuracy and reliability of accounting records and information. So internal control ensures that management has accurate, timely, and complete information, including accounting records, in order to plan, monitor, and report business operations. Third, to promote efficiency in the firm's operation. In this, internal control provide an environment in which managers and staff can maximize the efficiency and effectiveness of their operations. Fourth, to measure compliance with the management's prescribed policies and procedures. And in this, internal controls help to ensure the university is or the entity is in compliance with the many federal, state, and local laws and regulations affecting the operations of our business. Inherent in these control objectives are four modifying principles that guide designers and auditors of internal control systems. First, in the management responsibility, this concept holds that the establishment and maintenance of a system of internal control is a management's responsibility. In this, the management is responsible for maintaining an adequate system of internal control. They are responsible for communicating the expectations and duties of staff as part of control environment. Second, the methods of data processing. The internal control system should achieve the four broad objectives regardless of the data processing method used, whether manual or computer-based. However, the specific techniques used to achieve these objectives will vary with different types of technology. Next is in the limitations. Every system of internal control has limitation on its effectiveness. These include, first, the possibility of error. It means no system is perfect. Second, the circumvention, where personnel may circumvent the system through collusion or other means. Third is the management override. The management is in position to override control procedures by personally distorting transaction or by directing a subordinate to do so. Fourth, changing conditions. In this, conditions may change over time so that the existing effective controls may become ineffectual. And next is the reasonable assurance. The internal control system should provide reasonable assurance that the four broad objectives of the internal control are met. This reasonableness means that the cost of achieving improved control should not outweigh its benefit. So we have here three levels of control, which is called as PDC control model, which stands for preventive, detective, and corrective control model. So we have first the preventive control. And this is the first line of defense in the control structure. These are passive techniques designed to reduce the frequency of occurrence of undesirable events. This control force compliance with the prescribed or desired action and thus screen out aberrant events. So when designing internal control system, an ounce of prevention is most certainly worth a pound of cure. For example, a well-designed data entry screen. So the logical layout of the screen into zones that permit only specific types of data such as customer's name, address, item sold, and quantity forces the data entry clerk to enter the required data and prevents necessary data from being omitted. So second, we have the detective control. So this is the second line of defense. This control are devices, techniques, and procedures designed to identify and expose undesirable events that elude the preventive controls. These controls reveal specific types of error by comparing actual occurrence to pre-established standards. So when a detective control identifies departure from standard, it sounds an alarm to attract attention to the problem. Third is the corrective control. This control or action must be taken to reverse the effect of detective errors. So there is an important distinction between detective controls and corrective controls. In detective controls, it identifies undesirable event and draw attention to the problem. In corrective controls, it actually fixes the problem. For any detected control or detected error, there may be more than one feasible corrective action, but the best course of action may not always be obvious. For example, in viewing the preceding error, your first inclination may have been to change the total in value from 1,000 pesos to 100 pesos to correct the problem. This presumes that the quantity and price values in the record are correct, but they may not be. At this point, we cannot determine the real cause of the problem. We only know that one exists. So the COSO framework consists of 5 components: the control environment, the risk assessment, the information and communication, monitoring, and control activities. So the first COSO framework component is the control environment, where this is the first foundation for the other 4 control components. So this environment sets the tone for the organizations and influences the control awareness of its management and employee. Where this is, it seeks to make sure that all business processes are based on the use of industry standard practices. This can help ensure that the business is run in a responsible way. It may also reduce an organization's legal exposure if the organization is able to prove that its business processes are all based around industry standard practice. Additionally, the control environment can help with making sure that an organization is adhering to regulatory compliance requirements. In this, we have an important element that sets in control environment. These are the integrity and ethical values of management, the structure of the organization, the participation of the organization's board of directors and audit committee, if one exists, the management's philosophy and operating style, the procedures for delegating responsibility and authority, the management's method for assessing performance, the external influences such as examinations by regulatory agencies, and the organization's policies and practices for managing human resources. So is the risk assessment. In this sometimes referred to as enterprise risk management. This is based on the idea that risk is an inherent part of doing business. However, those same risks can sometimes cause a business to suffer adverse consequences, such as organizations commonly adopt risk management plans that help them to identify risk and either reduce or eliminate risk deemed to pose a threat to organization's well-being. So the organization must perform a risk assessment to identify and analyze and manage risk relevant to financial reporting. Risk can arise or change from circumstances such as changing in the operating environment, new personnel who have a different or inadequate understanding of internal control, new or re-engineered information system, significant and rapid growth that strains existing internal controls, the implementation of new technology into the production process, the introduce of new product lines or activities, organizational restructuring resulting in the reduction or in reallocation of personnel, entering into foreign markets that may impact operations, and adopting a new accounting principles that impact preparation of financial statement. The next component is the information and communication. The accounting information system consists of the records and methods used to initiate, identify, analyze, classify, and record the organization's transactions and to account for the related assets and liabilities. Communications rules are put in place to make sure that both internal and external communications adhere to legal requirements, ethical values, and standard industry practices. For example, the private sector organizations commonly adopt privacy policies establishing how customer data can be used. So the quality of information that the accounting information system generates impact management's ability to take actions and make decisions in connection with the organization's operations and to prepare reliable financial statements. An effective accounting information system will identify and record all valid financial transactions, provide timely information about transactions in sufficient detail to permit proper classifications and financial reporting, accurately measure the financial value of transactions so their effect can be recorded in financial statements, and accurately record the transaction in the time period in which they occurred. Next component is the monitoring. It is the process by which the quality of internal control design and operation can be assessed. This may be accomplished by separate procedure or by ongoing activities. At a minimum, monitoring is performed by an internal auditor who makes sure that employees are adhering to established internal controls. However, in the case of public companies, it is relatively common for an outside auditor to evaluate the organization's regulatory compliance. In either case, the audit results are usually reported to the board of directors. They gather evidence of control adequacy by testing controls and then communicate control strength and weaknesses to management. As part of this process, internal auditor makes specific recommendations for improvement of controls. So the last component is the control activities. These are the policies and procedures used to ensure that appropriate actions are taken to deal with the organization's identified risk. These activities are also tied to the concept of risk management. They are essentially internal controls that are put into place to make sure that business processes are performed in a way that helps an organization to meet its business objectives without introducing unnecessary risk into the process. Control activities can be grouped into two distinct categories: the physical control and the information technology. So we have here the segregation of duties. It is one of the most important control activities in employee duties to minimize incompatible functions. Segregation of duties can take many forms depending on the specific duties to be controlled. In this, segregation of duties is based on shared responsibilities of a key process that disperse the critical functions of that process to more than one person or department. Without this separation in key processes, fraud and error risk are far less manageable. So there are objectives in segregation of duties. The first objective is that segregation of duties should be such that the authorization for a transaction is separate from the processing of the transaction. So for example, the purchasing department should not initiate purchases until the inventory control department gives authorization. This separation of tasks is a control to prevent individual from purchasing unnecessary inventory. Second objective is that a responsibility for asset custody should be separate from the record-keeping responsibility. For example, the department that has physical custody of finished good inventory in the warehouse should not keep the official inventory records. Accounting for finished goods inventory is performed by inventory control. It is an accounting function. When a single individual or department has responsibility for both asset custody and record keeping, the potential for fraud exists. Assets can be stolen or lost, and the accounting records falsified to hide the event. The third objective is that organizations should be structured so that a successful fraud requires collusion between two or more individuals with incompatible responsibilities. For example, no individual should have sufficient access to accounting records to perpetrate a fraud. Thus, journal, subsidiary ledger, and the general ledger are maintained separately. For most people, the thought of approaching another employee with the proposal to collude in a fraud present an insurmountable psychological barrier. The fear of rejection and subsequent disciplinary action discourages solicitations of this sort. However, when employees with incompatible responsibilities work together daily in close quarters, the resulting familiarity tends to erode this barrier. For this reason, the segregation of incompatible tasks should be physical as well as organizational. Indeed, concern about personal familiarity on the job is the justification of establishing rules prohibiting nepotism. So in segregation of duties, we have the supervision. Implementing adequate segregation of duties requires that a firm employ a sufficiently large number of employees. Achieving adequate segregation of duties often presents difficulties for small organizations. Obviously, it is impossible to separate the 5 incompatible tasks among 3 employees. Therefore, in small organizations or in functional areas that lack sufficient personnel, management must compensate for the absence of segregation controls with close supervision. For this reason, supervision is often called as compensating control. An underlying assumption of supervision control is that the firm employs competent and trustworthy personnel. Obviously, no company could function for long on the alternative assumption that its employees are incompetent and dishonest. The competent and trustworthy employee assumption promotes supervisory efficiency. Firms can firms can thus establish a managerial span of control whereby a single manager supervises several employees. In manual system, maintaining a span of control tends to be straightforward because both manager and employees are at the same physical location. Next is the accounting records. The accounting records of an organization consist of source documents, journal, and ledgers. These records capture the economic essence of transactions and provide an audit trail of economic events. The audit trail enables the auditor to trace any transaction through all phases of its processing from the initiation of the events of financial statements. Organization must maintain audit trails for 2 reasons. First, this information is needed for conducting day-to-day operation. The audit trail helps employees respond to customer inquiries by showing the current status of transactions in process. Second, the audit trails plays an essential role in the financial audit of the firm. It enables external and internal auditors to verify selected transactions by tracing them from the financial statements to the ledger accounts, to the journals and to source documents, and back to their original source. For reasons of both practical expedience and legal obligation, business organizations must maintain sufficient accounting records to preserve their audit trails. Next is the access control. The purpose of access control is to ensure that only authorized personnel have access to the firm's asset. Unauthorized access exposes asset to misappropriation, damage, and theft. Therefore, access control plays an important role in safeguarding asset. Access to assets can be direct or indirect. Physical security devices such as locks, safes, fences, and electronic and infrared alarm system control against direct access. Indirect access to assets is achieved by gaining access to the records and documents that control the use, ownership, and disposition of the asset. For example, an individual with access to all relevant accounting records can destroy the audit trails that describes a particular sales and transactions. Thus, by removing the records of the transactions, including the account's receivable balance, the sale may never be billed and the firm will never receive payments for the items sold. The access control needed to protect accounting records will depend on the technological characteristics of the accounting system. Indirect access control is accomplished by controlling the use of documents and records and by segregating the duties of those who must access and process these records. Next, we have here the independent verification. The verification procedures are independent check of accounting system to identify errors and misrepresentations. Verification differs from supervision because it takes place after the fact by an individual who is not directly involved with the transaction or task being verified. Supervision takes place while the activity is being performed by a supervisor with direct responsibility for the task. Through independent verification procedure, management can assess first the performance of individuals, second the integrity of the transaction processing system, and third the correctness of data contained in accounting records. The example of independent verification includes reconciling batch total at points during transaction processing, comparing physical asset with accounting records, reconciling subsidiary accounts with control accounts, and reviewing management reports, both computer and manually generated, that summarize business activity. The timing of verification depends on the technology employed in the accounting system and the task under review. Verifications may occur several times an hour or several times a day. In some cases, verification may occur daily, weekly, monthly, and annually. So let's talk about information technology controls. This control drives the financial reporting process of modern organizations. Automated systems initiate, authorize, record, and report the effects of financial transactions. As such, they are inextricable implements of the financial reporting process that SOX considers and must be controlled. COSO identifies two broad groupings of information technology control, the application control, and general controls. The objective of application control are to ensure the validity, completeness, and accuracy of financial transaction. In IT control, it is a procedure or policy that provides a reasonable assurance that the IT used by an organization operates as intended, that data is reliable, and that the organization is in compliance with applicable laws and regulations. IT control are designed to be application specific.